And welcome back to the Lance Roberts Show podcast. News, by the way, coming January the 7th, the Lance Roberts Show goes back on the radio, 6 a.m. in the morning on KSTV. We'll be streaming that radio show live right here to our website as well as to our podcast channel as well. So you'll both get the radio show as well as our podcast in the afternoon. We're going to keep you fully up to date, but we're very excited about that. It's going to be a great opportunity. Lance Roberts Show returning to radio starting January the 7th. I thought I was going to retire from radio, but that lasted about 3 months. On Skype with us right now, Michael Lebowitz, CFA, of course, Portfolio Manager for Clarity Financial. My friend, how are you?
Good. How are you?
Doing well. Let's talk about a couple of things here, kind of some disparate things. I was listening to Donald Trump today, President Trump talking about he's very upset with GM because GM's talking about shutting down, several plants and retooling and laying off about 14,000 employees. Of course, not surprising to me that you would see that considering what's going on with auto sales. Auto sales are under a lot of pressure because rates have been going up. And, of course, after several, years of pushing out a lot of automobiles, the one thing we've seen is despite the fact that we report record auto sales, a lot of that really means that the automakers are producing record autos. It doesn't mean they actually sell them to individuals. There's been a lot of inventory stacking up on auto dealership, in the ports as well as at auto dealerships that really aren't moving through the economy. But, President Trump taking this very personally, talking about now cutting subsidies for GM and others. And you know what? I'm actually kind of all for that. I think we should cut auto subsidies out, period. We bailed out GM after the financial crisis, shafted the bondholders in favor of the pension funds and the pensionees. And we continue to bail out failing companies like Tesla. If it wasn't for the subsidy for electric cars, Tesla wouldn't even be nearly in business at this point. So maybe we need to stop supporting failing businesses and stop, providing all these subsidies. What do you think?
Oh, I agree 100%. Why are we subsidizing any company, any for-profit company at least? It's totally ridiculous. It allows companies that are not profitable or not as profitable as potentially other companies to stay in business and suck resources out of the economy.
Right. Then, of course, we talk about the debt and the deficit, and these subsidies are paid for by taxpayers ultimately. So I'm actually all for let's just get rid of subsidies and we can get rid of, and again, the reason for subsidies initially were a great idea, right? Because it allowed small farmers to compete with the larger farms. They got some help to help them, maintain a competitive edge. But because of consolidation and acquisitions and changes over time, the majority of subsidies go to the major mega corporations like Archer Daniels and others, and really give them a bigger advantage over the small independent farmer who has a very tough time staying in business.
That's right. I agree. I just do not like subsidies. I think they are a big drain on the economy. And I would like for Trump to come out and say, not only are we cutting GM, but we're cutting all corporate subsidies.
Yeah, especially electric car subsidies. Again, not that I'm against electric cars or anything. I think they're great. But, if you can build an electric car and run a profitable business, I think that's great. I don't think we need to be subsidizing failing businesses. We've done that with solar power companies. We've done it with a variety of other these green energy type companies. They all lose money. They do not have a functional business model, and they can't make it on their own. And so that tells you that maybe they need to rethink the model instead of putting it on the back of taxpayers.
That's right.
So let's, interesting enough, you wrote an article today talking about Fed Chairman Clarita, and not Fed Chairman, sorry, one of the Fed presidents, Clarita, making some comments about monetary policy and potentially what might be coming down the road. The big question here is, for the markets in particular, has been Jerome Powell, right? Is Jerome Powell going to continue to hike rates despite the fact that the market's run into trouble? And of course, the bulls in the market are all kind of begging at this point for some sort of relief from the Fed, right? Every time we've had a problem in the markets historically over the last decade, the Fed's always been there, either by voicing some issue or providing actual fiscal support of some sort in monetary form, there's always been the Fed, quote unquote, put there. Now it appears that Fed put is no longer there, and traders are starting to worry that maybe they're not going to show up. And so the question now becomes, is Jerome Powell going to stick to his guns and continue to hike rates into 2019, or do you think he pauses?
Right. The Fed put is a big deal. And last week, when everything was quiet, there were a couple rumors floated that the Fed may pause on their rate hikes come springtime. At the time, they were just rumors, and because they came from a reliable news agency, we are thinking a lot about it. And Vice President Powell's assistant at the Fed, Richard Clarida, you know how to pronounce it?
Yeah, we'll go with that.
And it spoke today, and then Powell is speaking tomorrow. So those two speeches, we are following closely for signs that the Fed may, in fact, change direction, or at least start putting on the brakes on what they've been doing. So today, Clarida spoke, and the gist of it, we had a big write-up in our RA Pro subscriber service today, but at the end of the day, I think what he was really saying today is that the Fed is no longer on autopilot. In other words, they're not going to raise rates every quarter by 25 basis points. They're not going to be as predictable. In other words, future rate hikes will be determined on economic data. And there's that conveys a few messages. One is that the Fed is much closer to the end rate, where the highest point where rates get to. But the other one is he's going to be introducing, if this is in fact the way Powell feels about it and the rest of the Fed, we should expect a lot more volatility going forward, because you're going from a very predictable Fed where forward guidance is predictable and meaningful to one where a Fed is dependent on individual economic data points.
Well, but that's not really too far different than what we had under Ben Bernanke. Remember, Ben Bernanke was always like, we're data dependent, we're looking at employment, and we're going to stop doing QE when we get to a 5% unemployment rate. Of course, when we got to 5%, they didn't, right? The data dependency became very subject to what kind of the market was doing and what kind of pressure was coming from the White House at that point to support the economy. And, probably Ben Bernanke should have, ended QE in 2014, maybe 2015 at the latest, and started this process of unwinding QE, but he kept the pedal to the metal for far longer than he should have. We had that big run up in the markets in 2014 and 2015, which, potentially exacerbated the problem we have now.
But following on in Bernanke's heels was Janet Yellen, who did actually, I would say, a decent job of warning the market what was coming. They were out there well in advance. Their forward guidance ended up being true. The market relied on her, and she delivered, and now Powell is delivering. And they have been very dependable. We know there's going to be a Fed rate hike in December, but we don't know. We are less certain about what's going forward.
The issue is that Jerome Powell has been predictable on this, but I guess the question is, you take a look at what's happening with oil prices. The oil prices are going to feed through the inflationary pressure. So inflationary pressures are going to fall. Break-even inflation rates, we covered this in this last weekend's newsletter on our website. Break-even inflation rates have already come down over the last couple of months. So, one of the supports for the Fed to continue raising rates was they were worried about runaway inflation, stronger economic growth than predicted. And of course, all that showing a lot of signs of weaknesses. So, has Jerome Powell gotten far enough away from zero to stop hiking rates, despite the fact that a lot of the data is already saying that he may have gone too far?
Fair point. And again, Clarida talked today about that, and he said that there are not signs of inflation nor in inflation expectations. But it sounds like he remains very concerned that employment is so low that it doesn't take much in the form of further gains in employment to start really pushing on wage pressure.
So the question is going to be really when we get the next unemployment report coming out in the first Friday in December, if that shows a big drop-off in job creation, which I don't suspect it will. But if it did, that's going to be kind of the wake-up call for the Fed to stop. The reality is that we're likely going to see fairly strong job growth. Look, it's retail season. We've got a lot of people getting hired, a lot of jobs going out to temporary workers for the retail shopping season. Very likely we're going to see a strong employment report that's going to give Powell the room to continue to hike rates. And the question is going to become, with auto sales already declining, with housing, I'm writing an article now for tomorrow on the housing market. I have an indicator called the Total Housing Market Index, which has turned sharply lower in the last couple of months. And in fact, it's broken the uptrend in housing that's existed since the 2009 lows, suggests that we have maybe just top-ticked the real estate market with the rise in interest rates. And the question is the Fed going to realize that sooner or too far after the fact?
And this gets to another point. Why are they raising rates? I wouldn't say aggressively, but why are they pretty persistent about their desire to raise rates? And we've talked about this. And I think at the end of the day is they know that if a recession sets in and Fed funds are at 2, 2.25, 2.5, they have nowhere to go till they get to zero. In the past 5, 6 recessions, they've lowered rates between 5 and 7%.
Yeah, 2.5 isn't really going to do the trick.
No, and we know Powell does not like QE. He spoke a lot about it in 2012 when we go back and look at the Fed minutes. And if you drop rates 2.25 right now or 2.5, you're going to be stuck with either negative interest rates or QE as your only tools.
Right. All right, we'll take a break, and we'll come back, and we're talking about the difference between a bull and a bear market, what actually dictates that. We'll come back and talk about that right after the break. I'm your host, Lance Roberts, Michael Lebowitz, CFA. And, of course, you can find all of the information that Mike was talking about at our website, Real Investment Advice, and at our new site, RIA Pro. It's all there for you. Of course, whatever we do to help, always let us know. Send us questions and comments. And make sure you subscribe to our YouTube channel at The Lance Roberts Show. We'll be right back after the break with the difference between a bull and a bear market. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.